What if one morning you walk to the bank and the doors are locked forever? Where's your money now? Imagine your savings like water in a glass. Suddenly, the glass shatters. Does the water just disappear? Today, we're diving into a question most people never ask until it's too late. What really happens to your money if your bank fails? We'll break it down with stick figures, doodles, and simple examples. By the end, you'll see how banks really work, what protections exist, and why your money might not be as safe as you think. Picture a bank like a giant neighborhood piggy bank. People drop money in, and the bank promises, "Don't worry, we'll keep it safe." But here's the twist. Banks don't actually keep all the money. If you deposit $100, the bank doesn't just stash it in a vault. Instead, it lends $90 to someone else for a car loan, a house, or a business. The bank is like a magician's hat. It looks like everyone's money is there, but most of it has already walked out the door. Normally, this system works because not everyone asks for their money at the same time. But what happens if panic spreads? Picture a line of people outside the bank, all shouting, "Give me my money back, now." This is called a bank run. And the problem is simple. The bank doesn't have all that cash sitting around. It's like a restaurant that takes 100 reservations but only has 20 chairs. As long as people don't all show up at once, everything seems fine. But when they do, chaos. Has this ever happened? Oh yes, many times. In the Great Depression of the 1930s, thousands of banks collapsed. Families lost savings overnight. In 2008, big banks faced collapse, and governments had to step in with bailouts. More recently, in 2023, Silicon Valley Bank failed in just 2 days after depositors rushed to pull billions out. History shows banks can and do fail. So where's your money in all this? Here's the good news. In most countries, deposits are insured. In the US, we have the FDIC. It guarantees up to $250,000 per person per bank. Think of it like a financial safety net. If your bank falls into a hole, the government stretches out a trampoline to catch you. So if you have $5,000 or even $100,000 and your bank goes bust, the FDIC steps in and you'll get your money back. But there's a catch. That safety net isn't infinite. If you have $500,000 in one bank account, only half is insured. The rest, poof, may be gone. And FDIC doesn't magically hand you cash instantly. Sometimes it takes days or weeks for your money to reappear. Imagine trying to pay rent or buy groceries while your money is trapped in financial limbo. It's like your bank account suddenly becomes a black hole. And not every country has the same safety net. Some insure less money. Some take longer to repay. And in weaker economies, governments might not have the funds to cover everyone. It's like insurance for your house. If the company itself burns down, can they really pay your claim? That's the risk. So how do banks actually fail? Banks fail when they make bad bets. Imagine a banker at a casino table gambling with customer money. Maybe they invest in risky mortgages, bad loans, or government bonds that lose value. As long as nobody panics, the illusion holds. But when people start asking for their cash back, the mask slips. The banker looks around the vault and realizes it's almost empty. So what happens step by step when a bank breaks? First, rumors spread. Customers get nervous. Withdrawals surge. Lines form at ATMs and branches. Then liquidity vanishes. The bank runs out of cash. Regulators step in, freezing the bank. And finally, resolution. Either a bigger bank buys it, or government insurance pays depositors up to the insured limit. So who actually loses? Thanks to insurance, small savers are usually safe. The real losers are shareholders, people who own stock in the bank, bondholders who lent money to the bank, and sometimes taxpayers if bailouts are used. The little guy often gets protected, but the bigger players take the hit. Can this happen again? Yes. In fact, it already has, many times. Technology makes it even faster now. Back in the 1930s, people lined up physically outside banks. Today, a bank run can happen on a smartphone in seconds. Imagine 10,000 people tapping withdraw on their phones at the same time. The system crashes, and within hours, it's game over. So what can you do? First, stay within insured limits. Don't keep more than $250,000 in one US bank. Spread it out if needed. Second, diversify. Use more than one bank. Don't put all your eggs in one basket. Third, be informed. Know your bank's health. If it looks shaky, don't ignore it. And fourth, consider alternatives. Some people hold cash, gold, or even Bitcoin as outside the banking system money. Think of your bank like a chair. Most of the time, it looks sturdy. You sit, no problem. But if the legs are cracked, you don't want to be the last person sitting when it breaks. Or better yet, don't put all your weight on just one chair. So what happens to your money if your bank fails? If you're under the insured limit, you'll probably be okay, after some waiting. If you're above it, you risk losing part of your savings. And if the system itself wobbles, well, history shows it's never impossible. Your takeaway? Don't just trust the glass to never shatter. Have a backup cup ready, because money isn't just numbers in an app. It's your security, your choices, your future. And protecting it is up to you.